I love it when you come here because you do something with us that's so highly instructive. You take us effectively on a global macro tour. And in that process, we inevitably find some surprising, perhaps contrarian, at the very least counterintuitive things that you have to say. I want to start with China.
Okay, so here's what I'd say on China. Our view is that China has already had its crash per se. I think many people are worried about the debt load and that China is going to slow down. If you look at it in nominal terms, which is inflation adjusted, think about KKR. We own lots of businesses in China. We've already seen a crash. I mean, nominal GDP went from 25% to 6%. That's a massive fall off. It's rebounded about 100% to 12, and now it's starting to settle in. So many of the sell-side economists focus on real GDP, and it has slowed down. But in nominal terms, which is revenues, paying your people, generating profits for your investors, we've already seen that. So from our standpoint, it's more, we would say, just a steady growth trajectory from here, albeit at a slower pace.
In other words, the China bears are looking for a correction in all the wrong places. They're looking down the road. Instead, they should be looking in the rearview mirror. From
a growth trajectory standpoint, I would argue that. I think the debt growth in China is going at an extraordinary rate. It's approaching probably 300% of GDP by the 2018. But I would say in terms of...
Does that concern you?
It does. It does. But I think when you're looking for a big growth slowdown, if you run a business, dropping from 25% to 6%, that's a pretty significant fall off that has already occurred.
And this chart helps to illustrate the point. Here's China's nominal GDP. Clearly, it peaked several years ago. And there's the crash, like you say, beginning to stabilize.
And I think that's why, recently just in Europe, you see better trends from the global economy. And some of that's reflecting China coming off the bottom. We're not looking for a surge. We're just saying it's stabilizing at a lower level, and that with a little inflation coming back to the system, you'll see that in the revenues of companies.
So let's talk about Europe. One of the things I found most intriguing in your research is this idea that, at least according to one of your models, the quantitative model, the European economy could grow faster than the U.S. economy in the not-too-distant future.
Yeah, I mean, we try to do both. I mean, I was just in Milan, Berlin, and London. We also do a lot of quantitative work to try to see if there's a disconnect or a match. And for about last year and a half, our quantitative models have been showing very strong growth. And the single biggest factor in that is monetary policy. And that's exactly what we saw in the U.S. when Janet Yellen and co were driving monetary stimulus, is just a huge impulse. And so what you're starting to see in Europe right now is that monetary stimulus shifting to the cyclical economic areas like housing. So you'll see a little more lending, a little more improvement. I heard there was a mention of copper, those type of things where it lifts the economy. And so it's this baton handoff where monetary policy acts as an ignition switch, and the fire it's lighting is a cyclical part of the economy. So right now, we've got a more constructive view, or we have had, on Europe, and I would say Germany is the epicenter of that. Germany really is a global player playing within a Euro region, and they're of all the places where we play in Europe, are benefiting the most.
Let's see if we can bring up a chart that helps to illustrate this point. The idea fundamentally is that monetary policy in Europe has gone from being a headwind back in 2012. Look at what it sucked out of GDP in basis points. To a tailwind now.
I think there are two forces at work. One is just the ECB and the monetary stimulus, and then this chart that you just brought up, I'm glad you're paying attention, this is the government going from austerity to actually becoming a contributor to growth. And so it's pretty amazing. You had a 150 basis point drag, and now that's shifting all the way up to a positive. So, mathematically, that would give you almost 170 basis point lift. Just from the government not kind of strangleholding. I mean, ultimately, over time, you do have to pay your debts, and you can't just have spending. But I think they've eased off the austerity, and that's also helping.
Meantime, you're calling for a recession here in the United States in a couple of years' time.
Yeah.
What's going to bring this about, right? People say that it's recessions are born of any number of different things.
Right.
Typically, a change in monetary policy. Is that what you see happening? Is there a catalyst in monetary policy, or are we just simply getting to the end of a cycle?
I think what we would say is, one is, if we do have a pullback economically, it will look nothing like what we had last time, where you had massive bank leverage and everybody owned a home, and that crashed and ate up their equity. From our standpoint, we have a pullback in 2019 where GDP goes closer to zero, more akin to what happened in 2001 than 2007. But I think one thing we're focused on is just
not pleasant, but not as painful as '09.
Yeah, and what I would say is it's really about compression of margins. And ultimately, we have, if you see in the piece, we have a much more modest forecast for inflation globally, including the U.S. And within that, I'd say we see margins compressing. And within the U.S. consumer, we're most focused on the lower end. And that's where we see some trends that I would say are not quite as positive as what you see at the aggregate level.
Henry, we've taken care of the macro half. Yep. Now let's talk about the how to allocate half. Yeah. Absolutely. Okay. You have 5 specific recommendations. Yep. I want to focus on 3. Deconglomerization, yep, a word I think you just coined, or at least I did for you. Emerging markets over developed markets, and this idea of embracing dislocation. Let's start with this deconglomerization. Okay. What specifically do you mean? We
are seeing, it's being driven by activists in the public markets. If you look at the Wall Street Journal today, B3, all the articles are on people forcing companies to sell subsidiaries. Corporations later cycle want to right-size their footprint. Many of them are selling off subsidiaries that are underperforming or trying to create value because activists are driving them. That's a great opportunity for what we do. Japan is on fire right now. We're seeing a lot of activity in Europe as well. And recently, yesterday, we announced a transaction in the 2 transactions in the U.S., one predicated on activism, the other one on a kind of a breakup story.
Is this fundamentally good for public equities?
Definitely. I mean, I think that you're seeing a lot of value created where when the cost of capital was so low right after the crisis, a lot of firms expanded into areas where they shouldn't have been. And I think right now, as the economy gets more mature, CEOs are rationalizing their footprint. We've talked about this idea that you should embrace complexity and dislocation in the past. So let's focus on why you say now emerging markets over developed markets. In our mind, look, we've had 8.5 straight years up in the S&P. There's only one other time in history that's happened. So just to keep it simple, multiples have expanded 40+%. You'd go where you haven't had the same benefit of multiple expansion. The second thing, in emerging markets, we are seeing margins starting to improve. Some of that is predicated on China, but some of it, the governments, after the taper tantrum, they got their houses in order. They took their real rates up. Inflation has come down a little bit. And it's just a better backdrop. A lot of investors are skittish about investing in emerging markets because of the currency risk. Yeah. And we're changing our call. I mean, we have been dollar bulls. I think what we laid out this year is the dollar is somewhere between fair value and full value. So we spend a lot of time as a firm thinking through for our investors, how do we want to hedge that? And I would say in aggregate, we're probably not at the same concern level that we were over the past, joining KKR in 2011, from 11 to 16. So that goes from being headwind to tailwind. Remember, currencies are generally about 30% of the total return in EM overall. So you have to get that right. It is embedded in being in emerging markets is you have to have a macro view.